On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. There are many sayings in the investment world, and one that always seems to come up at this time of year is sell in May and go away. This adage emerged in the Northern Hemisphere a long time ago, and it suggests that investors should sell their shares in May, then head off, relax, and enjoy the summer months, because remember the seasons are backwards in that part of the world. It's our winter, but it's the summer in the Northern Hemisphere, before returning to the market later in the year, in the autumn or the spring here in New Zealand. This is all based on a suggestion that the 6 months from November to April typically will offer better returns, higher returns than the May to October period. And there is a bit of truth to this if we look back at seasonal patterns over the years. I looked at US shares going back 80 years, and if you look at all of those years, the S&P 500 share market index in the US has returned on average 6.9% between November and April. And it's been up about 75-76% of the time, which isn't a bad hit rate. Now, in contrast, the other 6 months of the year, which are from May to October, that period has averaged a return of just 1.7% over those 80 years, and the proportion of positive returns falls to 66%, so the hit rate is not quite as strong. Now, that's going back to 1945, so it's looking back over 80 years. If you take the more recent past, the numbers aren't quite as lopsided as that. So I looked at the last 10 years, the last 20 years, the last 30 years of returns, and the numbers weren't quite as one-sided, but there still was a clear pattern of outperformance in that 6 months from November to April. It's typically just a better period for investors than May through to October. So that begs the question, it's May at the moment, will this work in 2024? Well, maybe. There's definitely a few reasons to think that we might see a few more bumps in the road over the next little while. For a start, the US market has had a cracking run, with the S&P 500 rising 17.5% just in the past 6 months. So that has been a very, very strong period. We've also seen double-digit returns from Europe, from the UK, from Japan, from Australia, and from emerging markets. So many of these share markets around the world have done very, very well. Not quite the case in New Zealand. We're up, but only up more modestly than that. Major indices in many of those regions that I've mentioned have hit new record highs in recent months. We've seen record highs in the US and Europe, in the UK and Japan, and in Australia. Emerging markets, not the case. New Zealand, not the case, but many of those other ones have seen the market hit fresh highs. So it wouldn't be surprising if we took a bit of a breather after a very strong run like that. Investors are also grappling with persistent US inflation. We've seen inflation rates in the US come down from where they were in 2022, but they've sort of got stuck. And over the last 9-10 months, they haven't been coming down any further. So what that means is that you've got a central bank over in the United States, the Federal Reserve, which looks quite unlikely to reduce interest rates over the next few months. We will see interest rate cuts at some point. The next move from the Fed will in all likelihood be a cut, but that probably won't come until late in the year. Maybe it's in September, maybe it's in November. Time will tell, but it's not on the horizon just yet. That could put a bit of pressure on markets, and it could keep investors just a little bit more cautious than we've seen lately with that high inflation and with central banks on hold for the time being. No cuts coming just yet. We've also got the US presidential election coming up in early November, which is less than 6 months away. Now, that doesn't mean there's any need for panic amongst share investors. Election years are usually quite good for the share market. I looked back over the past 20 elections, so that's going back to 1944, and on 18 of those years, 18 out of 20, the S&P 500 index was up in all of those years. So that's not a bad track record. I think that's a hit rate of 80 or 90%, which is actually a better proportion of up years than you see in any typical year. So election years are usually quite good for the share market. The only two instances of the S&P 500 being down during an election year over that period were 2000 and 2008. And those are two times where we saw quite big US recessions. So it's more about what's happening in the economy and what's happening with corporate earnings than an election itself. So the average return has actually been 10.8% during those 20 election years, and that's very close to the long-term average. It might actually be slightly above the long-term average. So don't panic over the election, but at the same time, those years do often prove to be a little softer than usual during the first half of the year. So you often get some of those gains coming through in the second half of the year, and that makes sense as well because you've got uncertainty, who's going to win, what will we see in terms of policy changes. We don't really know what's going to happen. And this year could be the same. You could see a little bit of uncertainty over the next little while as people just get a bit cautious about potential changes on the political front and what that could mean for the US economy and the US share market. So again, that's another reason why maybe this next little while might be slightly bumpier than we've seen in recent times. But despite those headwinds, I would be very reluctant to make any significant portfolio changes on the back of this sell in May concept. Every year is very different, and when you look at seasonal trends that sayings like this are based around, they don't ever account for the uniqueness of each period. So it's a very blunt way to think about markets, and just because history more often than not has proven to be right in terms of this May to November period, May to October I should say, being a little bit weaker than the other 6 months of the year, this year could be different. So you never want to bet the farm on any of those sorts of sayings or concepts or old mottos that you hear or read about in the press. Every year is different. If anything, this current point that we're at could be an opportunity for people to take a lower risk approach over the next little while because markets have had quite a strong run, or maybe to do a bit of spring cleaning, even though it's not spring. What I mean by that is to get out of some positions that no longer fit with your strategy. If you've got stocks, if you've got sectors that you're not completely happy with, always a good time to consider rebalancing out of those while markets are in fairly good spirits. And at the moment, when you've got share markets in many places that are close to record highs, it's not a bad time to do some rejigging if required. So maybe that is the way people should be thinking about the next few months. I certainly wouldn't do anything as drastic or as risky as selling out, then trying to time my way back in later in the year. You're really asking for trouble unless you believe that you're good enough to pick the short-term movements of share markets and interest rates and inflation and investor sentiment and geopolitical risks, and I'm certainly not. So I'm not going to make any big changes, maybe a bit of fine-tuning, maybe a slight tweak to my approach, but nothing too dramatic. And I think the other thing to point out and remember is that if we do see a bit of volatility over the coming months, whether it's to do with the US election that's coming up, whether you get some more news on the inflation front and it's not what we were hoping for, whether it's some comments from the Federal Reserve that interest rate cuts will come, but not as soon as we would like, who knows? Might be something else that comes out of left field. Maybe it's just that markets have had a good run and there are elements of highly priced stocks or sectors in places and investors get a bit nervous and you see a bit of a sell-off, whatever. If you do see some volatility over the next little while, I think that would be a good opportunity for those of us who have maybe missed the rally since last October, because it has been a very good run. Many markets are up 15 or 20% over those 6 months. this could be an opportunity for us to do a bit more buying. So that's what I think of the sell in May concept, and a lot of those other sayings that you do hear about from time to time. Worth noting, always interesting to consider, but I would not hang my hat on some of those old adages because they don't always work. So if in doubt, talk to your advisor and get them to work through any potential changes you might need to make. All right, thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.